Well, after that, we don't need any space. We can all get out of our offices and press a button and away we go. I came across ChatGPT April last year. I was doing a very short course over in England at a university there, and it was actually a property course, which I just thought I'd do for the hell of it. Anyway, I got with a team of people, young people. I was called the old guy, and we had to do a presentation on the creation of a fund. And while I was talking, because I've done this a few times in my life, and these young guys and girls were going, so how's this work? And I was saying, well, you work it out rather than me. But I shared with them how to put an investment memorandum together and those sorts of things. And there was a guy typing away, and then he said, so what about this? And he had the full IM in front of him. He'd just been on ChatGPT. We ended up winning. And he put this whole thing together through ChatGPT. So I'm kind of sold on that. And I think some of the other things that are very challenging for us in this revolution, instead of an evolution in our society and the tech that we're using today, is the impact that it has on property. Property is always evolving, has done since we had first built a hut and sought shelter in a cave or whatever. And really the property industry is all about shelter. We need to come together. That's why we're sitting in the hotel today. We're probably going back to an office, or we're going back to our home office, or we're going to somewhere to do some sort of commerce. It might be a factory, it might be a warehouse, it might be a shopping centre, it might be a shop, it might be a hotel because we're from interstate, all those sorts of things. So the one thing I do like about property, having been in it for over half a century, is that it's a very basic commodity. We can't get by without it. It's like food, if you like. We can't get by without shelter. So that gives me heart, because whilst it's emerging, you just got to figure out where to go and what to do. So I've been very lucky in my career to have been across literally every form of property ownership that I think I can imagine in Australia. I don't think I've missed too many things. So I'm just going to give you a 5-minute, 10-minute snapshot of what I see going on. It's a very short presentation. I didn't bother to put slides together, and perhaps I should have, but I can certainly get things to people if they so wish after this event. It's been a really interesting sort of 15 years. We had the GFC back in 2009. We had this amazing flood of credit available to us around the world, and that drove prices to a silly height. It also led to the GFC, and then we saw the unravelling of interest rates from 5, 6, 7, 8% down to zero. That kept on coming from 2009 onwards as the world tried to readjust and keep things afloat rather than hit a wall like a depression. I didn't think it would last as long as it did, and I think it was exacerbated by a couple of reasons. It might have been greed in Wall Street, probably a good thing, but it was also exacerbated by what happened in 2020. So if we remember back in 2019, I expected then rates to start moving up. Now, the property market is absolutely entwined with bond rates. Those two are joined at the hip. So when you looking at what's happening in yields, you've got to go to the bond rate, both here in the US, and that will give you a guide as to what's happening in the future, and it's never let us down. But in 2009, right through 2019, we went from I'll call it rates that we're kind of seeing today down to zero, and none of us have witnessed that in our lifetime. And of course, what's happened in and because of COVID, that kept things rolling. And I respect the governments of the world, and particularly our government, by saying we've got to keep things going, just keep it going. And we did an amazing job, and the government of Australia, I think, did an amazing job through the COVID period to keep everything liquid and flowing. But that had to come to an end at some time, and that started last year, about a year and a half ago, when we started seeing rates reverse, and we've now gone from basically 0.25 to 4.35, I think, so the official rate. And we're seeing borrowing rates at the cheaper end at 6.5% or just over 6% going through to the teens, where we play within Leftfield Capital because we're a provider of debt to the construction and development industry at the small end, and we've been having quite a good time in that. The other real thematic that's come out in the last few years, as everyone adjusts to this new period, is what is on everybody's minds as to where they're investing. And globally, it's four things. It's beds, meds, eds, and sheds. They're the four things that people talk about. And at this conference I was at back in April last year, and there were people from 19 countries around the world, the US, Canada, Middle East, right through Europe, even me from Australia, and a few other countries were represented there too, including Fiji. And I think the interesting thing was that theme. You know, if you talk to the head people at a CBRE, Global, the other major analytical groups in the world, they'd written off office, and in the States that's a good reason because they're overgeared. He's checking me, Tim Hannett. I'm okay, Tim. I'm on. Thank you. I lost my train of thought there for a minute. The office markets in the US literally collapsed last year. They were over leveraged. They had 70-80% debt. That's typical of the US. They always overdo those things. A lot of the secondary banks are still going through a massive amount of pain as that all unwinds. It takes me back to 1990 and the savings and loans crisis in the US, and the regional banks have just replaced savings and loans effectively, and they're going through the same pain. They've got to de-lever themselves. All that's got to be repaid somehow, some way. So the US is in a vastly, vastly different situation to us. We're in a vastly different situation a lot of other places in the world as well. But when you see what's happening in the US, don't just automatically think that's going to happen here, because it's not, and it hasn't. Nevertheless, we have adjusted, and cap rates have blown out by anything from 50 basis points to about nearly 200 basis points, or 2%. And that's across the board from office, retail and industrial, and every other sector that's around, with the exception probably of some of the specialised ones like childcare, which I had a business in. We had 400 childcare centres around Australia, and they've been very stable at around about a 5% cap rate, because they're smaller denominations and they're keenly sought after cash flows. Just running through the list, and I'll just start with not the eds, beds, etc., but office. The office market's going through a transition. We've had COVID, we've had work from home. That is still a very confusing issue for most people. I heard just this morning, I think the tax office has said, well, everyone can work from home, and that's all their staff can work from home. I know we've just done a major leasing to the tax office through Charter Hall, which I'm on the board of, and they've actually expanded their office space requirements rather than lessened them. And I think the interesting thing is there, all the government departments, or most of the government departments, are suggesting that people can work from home. It's coming from the unions, etc. I think that's a disaster. And I'm not talking about it just because of my interests in ownership of office buildings and other types of real estate. I just think in productivity that will collapse. And hearing about AI, of course, what's going to happen, in my opinion, is they'll go home, they'll be there, and then they'll get a paycheck. Their last paycheck is they're told they've been replaced by AI, because when they figure out they're not doing anything and they're just wasting all our time and money, we would be better off taking about 2/3 of the public sector, paying them a wage and saying, please stay home, don't use the public transport, don't use the services that we provide so you can get to the office. We would be a far more productive country. But I better be careful about that. There might be people that disagree with me. So the office market's bifurcating. We've got all major companies are expanding their footprint in office, which I find interesting. And it's also getting confusing because they're not providing enough space for 100% occupancy, even 90% occupancy. So they're now realising if they want to get people back to work, and most major corporations do want that because they're seeing productivity fall through the floor, then you can't. How do you get promoted by sitting at home behind a screen? Now I know AI is terrific, and I know Zoom is terrific, and I'm a great user of that medium to save a lot of air miles. But how do you get people to know how to interact with other people? How do you get to sell? How do you become a good lawyer if you're not at the feet of an amazing lawyer that's had 30 or 40 years experience showing you how it really works? How do you do that? And I'm very old-fashioned, obviously, but I just can't see how that can work. I think humans need interaction, and I think we'll go through this wave, and I think a lot of people will be replaced by AI for good reason, and they'll find employment elsewhere, and they'll find new challenging things to do, because we as humans are incredibly inventive. We're very, very creative. If you look at we all do, look at what mankind's done, man and womankind, sorry, over the journey, we've replaced ourselves. We've been through agrarian, industrial, technology revolutions, evolutions, etc., and we've always gone forward. What's happening in medical tech, for instance, is just mind-boggling where we've come from in the last 20 or 30 years. Anyway, back to my theme. So office, I'm not frightened by office. I think a lot of the secondary and tertiary stock, B, C and D grade stock, will be turned over to other usage. We're talking, I'm not just ringing about a fellow I know, it's just buying office buildings now and converting them to co-living space, not build to rent specifically, but co-living. It's a slight variation on rental space, somewhere between a unit and a hotel room. I think he's working on developing 3,000 apartments in that type of sector in this city and Melbourne and elsewhere. So these buildings will be replaced, they will be reused. That happened back in 1990 as well, where a lot of stock then was converted, particularly in Melbourne, to residential space. Central Equities did an enormous amount of work down there at that time and created a new opportunity. The bifurcation means premium office space will improve. Those cap rates have gone back to more stabilised rates around 5-ish%, and that's going to stay there. There's decent growth coming through with our rents, and the rents that we're doing at Charter Hall with our new building we're doing at Chifley South, which is a $650 million build. We're now 70% pre-let and we haven't started working on it yet, and that's been leased at over $2,000 a square metre. And whilst vacancy rates in office is around 15-16% across the board, you've got to be very selective about where you go and what you do. Industrial, that's had an enormous run over this last decade. There's a whole bunch of things driving that. There's the merge, if you like, of retailing and e-tailing, away from bricks and mortar into click and collect and delivery. And we're now seeing people like Amazon take enormous amounts of space where you can order online and it gets to you. And then there's last mile delivery as well, where you have smaller places around the city where those goods are sent to and then sent out from there. Interesting enough, their yields went down as low as 3.3%, which I could never get my head around. They're back at sort of 5% now. They've had the biggest blowout, and yet there's virtually no vacancy in industrial, and there's very good rent growth for the first time in my lifetime, where we've really seen very strong rent growth, and that's going to continue now for the next 2 or 3 years. People like Goodman, indeed Charter Hall, other interests dominate that market and the big shed market, but the last mile logistics and smaller parks offer very good returns as far as I'm concerned. Data centres are very interesting. That's where all the data goes, where the cloud is. And if you have a look at those things, they are amazing boxes. I've been lucky enough to go through a few of them, and the machinery in there and the technology in there is amazing. There's one just out by the airport, owned by a large US REIT, Real Estate Investment Trust, that just does data centres. It's interesting, I couldn't tell you exactly how many square metres, it probably doesn't matter because it's all the energy, but that data centre uses the same energy as 220,000 homes. And it's one data centre just out here on Mascot. Now you think about that for a minute, and you think about energy, and you think about the so-called change from to renewables, which is going on at the moment, and I am totally confused about how the hell they're going to get there with the need and the growth in energy usage, and the fact that we don't matter in terms of that globally, because energy is going through the roof, driven by technology and the need. Retail, quickly, major centres, that's discretionary and non-discretionary spends. I believe in the non-discretionary side of it rather than the discretionary side, because in the discretionary side you can simply go and look, but you don't have to buy there. You can buy online. And at the moment, because of the pressure on cost of living pressures, discretionary spend is kind of way down. The other influence will come about as the boomers, as we pass through, we consume less and less. We don't need any more clothes. I can't say that to my wife, but I don't need any more clothes. Kerry's very frugal, I have to say. She's got so many wardrobes of clothes in our house to prove it. But retail, in the discretionary, non-discretionary, food-based, convenience-based stores, that's things like petrol stations, which will turn into energy stations. They are small retail centres. They're doing very well. The build-to-rent space, I'm confused about in this country. It's a very good sector in the US. It's emerging in the UK. It's always been a sector in continental Europe, which came about after World War II, and they needed to produce accommodation for workers, same in Japan. But in this country, I'm a bit sceptical about that, although other people that are smarter than me are very committed to it, and I think there is a place for it. It's just hard. I think you need the big players to do it, and they will do it well. Co-living, I mentioned, that's another subset. Life sciences, that's the meds bit of what I was talking about before. Not so prevalent here, but big in Asia and other parts of the world. We just don't, with 26, 27 million people, we don't have the depth in medical sciences and we don't have the major pharma companies actually operating here, although some are talking about it. So it's a possibility, but I don't see that as being a big part of the subset. The hotel market has rebounded terrifically well after COVID. I own a couple of hotels and we're pretty much running at 85 to 90% occupancy and increasing room rate. It's a specialised sector, but one that I kind of like. The residential market generally has been incredibly buoyant, as we know. In this state, the biggest issue in residential is the ability to get approvals, and we were talking just earlier before this that this state is a mess in terms of approvals. And one of my people I met here is from Queensland said he comes down to the Tweed but doesn't come any further because you can get an approval in Queensland as an as of right use straight away. I've just finished one little project I had, which was a rebuild of an existing building. It took me 3 years to get a DA to replace what was already there, with the only changes being additional toilets. So worked that one out, and just to get the final approval from the council, they changed their mind 2 times, and I won't go into it, but it delayed the opening by another 3 months. I've had the same happen to me and other things. We're just bloody-mindedness from bureaucrats means that it just takes an inordinate amount of time, and I'm telling you that because if you've got a local member or anyone, please yell at them because it's ridiculous. For all the nonsense that goes on it, we're going to, from the federal level, going to build 1 million new homes that over 5 years. Well, that's actually what we do build over 5 years. It's roughly, we aim to do about 200,000 units of housing per annum. We get away with doing about 150, so there's an inbuilt shortfall along the way. And this state is not assisting that. And I hope that the current Minns government can do what they're talking about and get that change, because it's a nightmare. But in other parts of Australia, it does work efficiently, just about in every other jurisdiction except for this state, and God knows why we don't do it, but we can't seem to get our head around it and do it properly. So in summary, I'm quite bullish about the opportunities both in the debt and equity space of real estate. You've got to be very mindful of supply and demand. That's the key driver to success. You've got to look at those areas that you think will potentially outperform. If you look at the residential market, for instance, you look long-term, its growth has been between 6 and 8% per annum compound, and that'll do me any day of the week in terms of long-term investment. But it's all about the obvious things of where is it, because if you're on the outer edges of the city, it'll take a lot longer for that to occur until the pressure comes up. But in the inner areas of all our major cities at the moment, we're going through a very steady improvement in demand, and with a lack of supply, that can only lead to one thing, which is higher prices. Thank you for your attention.